pensions or college funds, that kind of big pension funds, they're just looking for continuous return on equity, which would be through the mortgage payment. So some of every mortgage payment goes to the paying down the loan, and the other of it goes to interest, and that interest gets pushed forward onto the end investor.
Okay, well, that's fantastic. So in other words, if I were to kind of put it in my terms, I own a home and somebody has invested in my future, and in essence, what they're doing is I'm making payments to them for the investment they've made in me. Is that kind of how the investor works?
Correct.
So you're working directly with those investors to make sure that all the loans that we have, in other words, the ones that we're consistently working on, originating, and helping people get, that they're transferred and sold to them directly.
Yep. So we're an intermediary from the loans that Chris brings in to the end buyers.
So you're actively involved with what's going on in the market. Before I get into that, I want to make sure I point out Virginia Tech. So you've gone to Virginia Tech.
Yes, I grew up in Virginia Beach. Went to Virginia Tech, go Hokies. As you can see a little bit, I played lacrosse there, and then after I graduated, started my first job here at McLean Mortgage, and been in the secondary department ever since.
That's very nice. My daughter's actually going to Virginia Tech in the fall if they still have classes there. So we're hoping that all works out. That's fantastic. So now I heard through our last conversation that you actually coach lacrosse too. Is that right?
That's correct. I am the head coach for George Washington University. It is part of the same club league that Virginia Tech's in. So I get to play them every year, which is fun to see. Well, I used to play my old teammates, but now it's been a little bit too long for that.
Very nice. Very nice. Well, that's fantastic. So tell me a little bit more about the situation with the secondary market, because the secondary market, I mean, kind of like we've seen with toilet paper and the grocery stores and different things like that, there's been a lot of changes in the last 30 days. Kind of describe what that path has looked like, and so that the agent who is reading or watching this is able to catch up.
Okay, so I would say in about January, mid-February, we were looking. We were very stable. We were in the election process. The Fed was very happy with where interest rates were going, and overall the economy was going to look like it was going to be stable from now through the election, and then obviously we had this COVID-19 come up. So the first thing that happened was there was fear of what's going to happen. I think it's the greatest problem that all humans face is fear of the unknown, and so a lot of people they took all their risk away and were all looking for cash in the easiest way. And the Fed does not want everyone to just sit there and hold their cash. They want people spending money. They want the economy to keep moving. So the Fed threw a bunch of money in all kinds of sectors, but specifically into the mortgage sector. They thought that there were not enough players that wanted to be buyers. There was just too many sellers. And so just to fix the supply-demand graph, they wanted to provide buyers. What ended up happening is that everyone just became a seller because the Fed decided to buy everything. And that created a lot of volatility. And then in the last 10 days or so, they figured out what number works best to keep the buyers and sellers stable. So the last 10 days, we've seen the most stability of the mortgage market since, end of February.
Right. And so in essence, what you're seeing is the volatility that we've seen in the market the last couple of weeks has really been, some of it's been mainly just fear induced. Is that what I'm hearing?
Yes.
Okay. And so how did some of that fear materialize to the borrowers that are out there? What did that look like?
So the fear materialized into I would say the first thing that happened was, the mortgage interest rates dropped crazy because a lot of people were trying to buy bonds, get out of stocks. The stock market was dropping like crazy, and so the bond markets were going up because of that new demand supply. And then the demand supply started to drop also because people didn't want to be in anything. They just wanted to be in their own cash. They didn't want to buy bonds. They didn't want to buy stocks. They didn't want to buy anything. And so that's when the Fed decided to jump in. So I would say that's what that was the main course of action, and that's why in beginning of March there was crazy good rates. Then it kind of dropped off, and now again we're back into good rates because they figured out how to make the supply demand equal to each other.
Okay, and so what I saw happen, and I'll just kind of share my story with that, is I saw the rates in mid-March, early to mid-March, it felt like they bottomed out. And then I was getting 45 to 50 phone calls a day. I had 50 voicemails that I couldn't keep up with. It was like crazy stuff. And then all of a sudden, it's like COVID's in the United States. And then all of a sudden, it's like everybody's going to die. And then all of a sudden they kind of started pulling the plug, and then the relief package came out, and it affected certain borrowers more heavily than others. So why did they kind of affect certain buyers? What was the point behind their thought there?
So to follow your story, I would say what first happened is people like Chris, they broke the mortgage market. No, they
Yeah,
took
it's
too
my
many
fault.
applications.
Right
They made too much. They made too many people happy. No,
here.
what started to happen was the fear of, which has subsequently happened, was people were beginning to lose their job, and were they going to be able to make their mortgage payment? So a lot of the buyers in this situation did not want to buy because they were afraid. What if they can't make their payment, or what if they don't have a job? Um, so the Congress came in and decided that we're going to allow borrowers to up to 3 to 6 to 12 months not have to make their payment. And so that was a huge relief for each homeowner. Anyone that owns a home now, they all can actively participate. But the negative consequence in our industry is that the people that are collecting these payments could no longer forward that payment to the end buyer. And so the servicer, who's the one collecting the payment, could not forward the payment to the end investors. And the servicers were afraid, well, I have to forward this money, but I don't have the money because they don't have to pay it. And so part of what happened in March is that they they're they were afraid of how we're going to deal with this. And so we don't want to buy anymore because we don't know if we're going to have the money to be able to make that payment forward.
Mhm.
Uh, I would say in the last, since about the end of March, there's been a lot of um, Congress, both Congress, Ralph Northam, Steve Mnuchin have brought up, okay, we need to come out with ways to fix this problem, which has cured a lot of the fear because we know that it's on their plate to look into, but it's not an immediate thing that we have to fix because those payments are coming, May 1st, June 1st, July 1st, August 1st. Those are not the problems we're trying to fix right now. They're trying to get money in people's pockets through the stimulus plan. They're trying to get money into the small businesses so that they can make their payroll payments. So those are immediate problems they're working on. But the fact that they know that they're going to talk about fixing those problems in the future is what's created a lot of stability.
Okay, so what you're saying, if I'm hearing you correctly, is that there is a point in time when this is going to get back to a more normalized setting. Excuse me, that's just allergies. It's not Rona. Um, it's going to get more back to a normalized setting as far as being able to get people back into, because right now we're seeing in some of the lower prices, and we still have stuff for 640, we still have stuff for 620, but sometimes the pricing on it, meaning the points that they have to pay for these loans, are pretty significant. So what you're saying is, if I'm hearing you correctly, is that as they continue to work through these domino effects, that eventually it's going to catch up and it's going to get the market back to where we need to be.
Yes. So I would say the more good news you start to hear on TV about the number of cases that are coming, uh, the hopefully we're reaching the peak and we're starting to come down. That will fix a lot of the fears of what will also happen in the mortgage industry. Uh, the borrowers right now that are the most affected are the lower borrowers, especially in the VA and FHA programs. Lower credit score borrowers, sorry, not lower borrowers, lower credit score borrowers in the FHA and VA programs. I think in my opinion, it's a little bit unfair that they've decided that they are the most unlikely to make their payment, but that's kind of where the industry is looking at it right now. They're looking in the rearview mirror from 2008, from the 1980s, deciding that these were the most likely to default back then, so they're still the most likely to default moving forward. But in my opinion, the most likely to default are the people whether or not they have their job. Because if you have your job, no matter what type of loan you have, you're going to keep making your payment. So if you have a conventional loan where you put 50% down, if you have an FHA loan, you put 3.5% down. If you have your job, you still make your payment. It doesn't matter that you had 50% in your house. So that's where they're looking at. They're looking at old, I would think, outdated models, but uh, that's how a lot of the economists work right now.
So in essence, because of that fear, what they've done is a lot of banks, I mean, I'm saving a couple right now from BHDAs where the bank just said, we're no longer doing any of these. We're just not going to touch them. And anything under 680, we're not going to touch. Anything under 660, I mean, I've heard as high as 700. So what do you see with that? When do you see that kind of working its way out? What is the temporary nature of it? Because at some point it has to recover.
Well, I would say for McLean Mortgage standpoint, we are going to do all of VHDA's loans. We have not stepped uh, out of that arena at all. I would say for the borrowers under 680 and an FHA and VA loan, it's probably 30 days out before we see that smooth back into, as long as the news about reaching that peak of what's going on with the COVID-19, I think it'll start to smooth itself out in the next 30 to 45 days.
Okay, so that's kind of nice. So it sounds like we're going to get at least a big part of the spring market back, because that tends to be what the domino effect is in real estate, is that first-time home buyer then buys the move up, first-time home, and move up, buys the next one, and so on. Every first-time home buyer is almost like 4 transactions in a row. So share with me a little bit more about this in general terms. I mean, there are other factors that are affected too. Being one of another ones. I know a lot of people who are going to be watching. They function in this jumbo market too. Kind of talk about what's going on there, because we haven't lost the jumbo loans, but there are certain investors who have gone away. What does that mean?
So in the secondary market, there were banks that were investing in the jumbo loans to hold on to. So Wells Fargo, J.P. Morgan Chase, um, U.S. Bank. These type of lenders were planning on holding onto these loans and keeping them. There are other lenders who would sell these to end investors. Uh, and basically, what's happened is those end investors have completely pulled out of buying any of them. So anyone that did not plan on keeping that loan is no longer part of buying of making these loans. So a lot of the what was in our industry called non-QM, or what in my terms is less than 20% down, 43 uh, back end DTI. Basically, that whole market is completely gone. So we're back to the old 20% down, highly qualified, have reserves in their pocket. Those are the only loans that are being originated right now in the jumbo market, which we still have here. We're still originating and selling them, and it is because we're selling to the right people that are doing, I think, making the correct choices in this market. There are some other lenders who have decided we're just going to cut off for a little while, maybe come back. Who knows? I think they're going to miss out on the opportunities that we still have.
So I just want to make sure I accentuate the point of what I'm hearing you say, because if I'm hearing you say this correctly, lending itself hasn't stopped. Certain investors, meaning the banks who are actually funding these loans, those investors have stopped, but that's not necessarily everybody.
Correct.
Okay, and also to build off of an earlier point, the changes that have happened in the market with the first-time home buyer are not necessarily changes that have been accentuated by FHA. They've also been because of the investor themselves.
Yes, it's mostly due to the fact of the fear of having enough cash to be able to pay the the servicing payment that is due at the end of each month because of forbearance. I believe that Ginnie Mae has come out with on last Friday. They came out with a memorandum talking about how they're going to help these people make these cash payments And I believe in the next, in the next 15 to 30 days, there'll be more guidance from Congress and Fed about how they're going to help out. But I think right now they're just too focused on getting that money out to the people right now, but they haven't put those steps forward yet. But
Sounds like that's going to start working its way out of the system very soon. You know, maybe 45, 90 days, we should be back to a normal lending environment.
yeah.
More normalized. Okay. So based on the conversation that we've had this morning, what are some of the things that we can share? Because fear is in the market everywhere right now. Some lenders are just running around like their hair's on fire. I don't have any, so mine burned off a long time ago. I'm okay with that. But what are some of the things that we can help them as they're talking to their first-time home buyers, or talking to their jumbo buyers, or talking to other people in these market spaces? What are some comforting words that we can share with these agents so that they can go ahead and take that into their conversations down on the street that'll help them with generating leads, or at least getting their buyers to settle down on this stuff?
Okay, I think the first thing that's going to help both the buyer and seller is the evaluation practices for the home, specifically appraisals. For the purchase transactions, across the board, they've made much more lenient guidance in terms of you don't have to go in the house every time. You can do an exterior appraisal. You can do what's called a desktop appraisal, where you use data from from MLS and other like sales to make the valuation. And then lastly, they've expanded the amount of loans that can qualify for a waived appraisal on the purchase transaction, and how high the loan to value has to be. So I think number one, the fear of I've seen a lot of fear of sellers. They don't want people in their house, and so how can you buy the house if you can't get it appraised? So that's one of the big things that they forward thinking. Okay, how do we fix this to make sure that these homes can still sell? Secondly, for the buyers, is they've made the practices of how to re-verify employment much easier. So before, we used to have to pick up the phone, or a specific computer work number through Equifax to verify the employment. Now we can take emails from HR. We can uh, and and that's going to make it a lot easier rather than having to call every time, because you might call in and no one's in the office, everyone's stay at home. So it's made that a lot easier. So those are two of the main points specifically to the borrower. For the first-time home buyer question, I would say we're still, like I said earlier, we're still completely using VHDA. We have 3% down conventional programs, and we still have the FHA and VA programs. If we haven't gotten into the completely lower credit score spectrum yet.
Right, and that's mainly because the investors aren't willing to buy them at that point. But the VHDA, so what has the VHDA, because you sent out a memo just a couple of days ago on some affidavit they're making us sign. What is the intention behind that affidavit?
So the affidavit is basically the day of closing, the lender is going to provide to the borrower and say, you know, uh, I'm signing this form that says I have full ability to make my mortgage payment. I do not plan on going into forbearance immediately once I close. So what VHDA is looking for is a comfortable, just signed document that says I can make this payment. I want to buy this house. They in the affidavit itself, it says, if you were to lose your job afterwards, well, that was unforeseen. You didn't know that was going to happen. But if you lost your job maybe 2 days ago and you still went in to buy the house, but you knew you could get forbearance, that's the kind of actors that they're trying to work around. It's not necessarily to deter any purchasers. They just want to make sure that people that are buying these houses are in a space where they know that they can continue to make their payment.
Right. And so that's just kind of what they're doing there. Okay, so we have about 2 more minutes left. What are some final, you're so close to these markets on a daily basis, and you're so close to what's happening out there. What if you could just put one word in the realtor's mouth as they go forward from here, what would that be, and what would the positive outcome be that we would be able to share with them?
I would say that the end investor buyers are coming back. There was a big fear and a lot of them started to drop out, they're coming back. They're asking us for business. They want to know what they can do to get more from us. So I think that is the biggest part, is having a diverse amount of buyers in the market. Because for a while it was pretty much only the Fed, and now we're getting back to the end investor wanting these loans again. That's the biggest part from my department standpoint. For as far as the sales team, I think there's a lot of opportunity, and I think the spring market is just going to get pushed back, but it's going to be alive and strong.
Mhm. Okay, well, that's great. Well, thank you so much for joining me today, Kurt, and really spending this time to break down what's happening in the market, what's happening with a first-time home buyer, and also give the realtor some talking points so that they, in essence, can share this with their clients, and they can, in essence, share the good news that this too shall pass. It's not going to be like 2009. It sounds like it's going to recover sometime in the next 30 to 90 days, maybe a little bit more, but in essence, we're going to be on the right path here very shortly. So, well, thank you so much. And if you're at home and you do have questions for Kurt and you would like to ask them, don't hesitate to contact me. I'll pass them on to Kurt. Kurt may even call you directly. I don't know, but we'll certainly make sure that we address your questions and that you get this live thing. We're just so thankful for you guys trusting us with your business and for the opportunity to share this. Any final parting words, Kurt?
No, I just want to reiterate. Thank you for trusting McLean, Chris, and thank you very much for part of it.
All right. Well, thank you so much, and we're going to let you guys go. Thanks so much. All right. I'm trying to stop the recording here.